Welcome to Mini Money Mastermind with Mahira. Let's say your mom bought you a television or a laptop for your home in any state of India. Now that television or laptop which your mom bought for your home is added to India's GDP. Wait, what's that? In fact, if you're living in any corner of the world, almost everything around you is a part of your country's GDP. Now, what's gross domestic product? In short, GDP. It's a very common term which you're hearing or reading in the news very frequently. Do you know that it's a tool used to measure the size and the health of a country's economy? So today, I'm going to discuss all about gross domestic product, how it is calculated, what is a financial year, how a financial year is different from a calendar year, GDP, like gross domestic products, advantages and disadvantages, what is GDP per capita, and what is GDP growth rate. Gross domestic product, in short GDP, is the market value of all final goods and services produced within a country in a financial year. Here are the top 5 countries based on their GDP. Recently, India moved from the 6th position to the 5th position. Before that, the United Kingdom used to be in the 5th position. So first is United States with a GDP of 25 trillion. Second in the list, we have China with a GDP of 18 trillion. Third in the list, we have Japan with a GDP of 4.3 trillion. Fourth in the list, we have Germany with the GDP of 4 trillion. And fifth in the list, as I told you, we have India with the GDP of 3.4 trillion. Now, all these numbers are in the form of US dollars and not the country's currency like the German mark or the Indian rupee. Okay? So these all digits are in the form of US dollars, as you know, is a very powerful currency. Now, as I told you, GDP is the market value of all final goods and services produced within a country in a financial year. Now, to understand GDP, we first need to understand a financial year, right? Now, financial year does not need to correspond the calendar year. So a financial year can begin at any date, but it should be a 12-month period. Many countries choose to have the calendar year as a financial year. Some organizations may choose a different period of time. For example, April 1st to March 31st of the next year. Now, the purpose of having a financial year for businesses and governments is to track their performance over the specific period of time and then make financial reports for stakeholders and shareholders. A financial year, also known as the fiscal year, is a 12-month period used by companies and governments for accounting and financial reporting purposes. For example, a company's financial year can start on April 1st of the present year and end on March 31st of the next year. Now, over here are some of the countries' different financial years. See? On the top there's India, then there's United States, Canada, and many more. And see, like there Even some countries have the same financial years period. Even companies have different financial year periods according to their own country. Like see over here in there is Microsoft Corporation and then there is United States. Both have a different financial year period. Now you've understood what is a financial year, and now let's understand the difference between a financial year and a calendar year. Now a financial year and a calendar year both are of 12 months, meaning that one thing that is important to note down is that both calendar year and financial year are 12-month periods. Now, the main difference between calendar year and financial year is that a financial year should be of 12 months but can start at any date and end at any date, just meaning that after 12 months of the starting date. Like the calendar year starts always on January 1st and ends on December 31st. But in India, for example, the financial year starts on April 1st and ends on March 31st. And also, the financial year differs a lot across the world, but the calendar year will always remain as from January 1st to December 31st. Many countries and organizations, as I told you, even keep the calendar year as their financial year. So many countries do have the same financial year and the same calendar year. Many organizations and countries do that, but most of the times the financial year is different from that of the calendar year. Now we've understood the main difference between the calendar year and financial year, and that's all the differences I know. So I hope you've understood that what is a financial year and the difference between a financial year and a calendar year. Also remember again that the financial year and calendar year both are of 12 months. Now, if you have a bit confusion in understanding this video, you can rewatch it again and again, and then your brain will process it again and again, and you will finally make out a meaning of this video. So now let's come back from biology to what we were doing earlier, GDP. Now this GDP video is related to general knowledge and governments too. So I'll also post the playlist link of general knowledge of money and government money in the description, and you can watch all the videos in those respective playlists by clicking on the link. Also, my all videos are available in the Hindi subtitles as well. Now let's come back to GDP. GDP is often used as a measurement of the overall health and growth of a country's economy and is used by governments, businesses, and investors to make proper decisions about economic policy, investment, and trade. GDP is calculated by adding up the value of all goods and services produced within a country. That includes consumer spending, investment, government spending, and exports minus imports, which are often referred to as net exports. Now, are you confused? Don't worry, because I'm here and I'm gonna give you an easy peasy formula so that you can easily understand what I meant by the last line. Well, the formula is consumer spending plus investment plus exports plus government spending minus imports equals GDP. Now let's discuss all the terms. Consumer spending. Consumer spending refers to the amount of money spent by a household or an individual on goods and services in a particular period of time, typically a year. It includes all items. It includes all expenses like items such as housing, clothes, transportation, healthcare, education, entertainment, and other such discretionary items. Now let's talk about the different kinds of goods before continuing consumer spending. First is intermediate goods. Now let's understand what are intermediate goods through an example. Now the example starts with a baker. A baker buys wheat, cream, eggs, fruits, sugar, etc. for making a cake. These goods are intermediate goods and are not added to the GDP of the country to prevent a double counting of the same product. Then a customer comes to that shop and buys the same cake which was made up of intermediate goods. Now the consumer bought that cake and some eggs. The cake was for a birthday and the eggs were for making omelets for the guests. Now these goods will be added to the GDP of that country, as there will be no double counting of the goods, as now they will be finished goods and the customer won't sell those goods to someone else. There are goods known as finished goods but are still used to make other goods. Let's understand that too through an example. Let's say a farmer brought a tool. Now that tool has two ends and both of the ends are used for different purposes. One end is used for digging and the other end is used for fixing screws or tightening screws. So the farmer uses that tool for digging the farm and fixing or tightening the screws of his tractor. By this tool and tractor, the farmer can produce many crops like potato, wheat, barley, maize, etc. Now, the tractor and the tool both are finished goods but are still used to make other goods. In this example, they were the potatoes, maize, barley, wheat, or whatever crops the farmer produced. So these kind of goods are known as capital goods. Also, GDP counts the goods produced within a country. So if an old laptop is being sold to someone, then that laptop won't be counted into the country's GDP. Also, the GDP counts the goods and services produced within the country. So if some rice is grown in India and is sold to, let's say, France, then that rice will not be counted into France's GDP because a rice was bought somewhere in France, but is counted in India's GDP because it is produced in India but is sold to France. So now let's come back to consumer spending. Consumer spending is an important component of a country's gross domestic product or GDP and is often used to measure the overall economic activity or health of a country. When consumers are spending more, it typically indicates that the economy is growing and vice versa. Consumer spending can also have direct impacts on businesses. Because if consumers are spending more, then businesses will flourish, and it can happen the other way as well. Factors which influence consumer spending include income levels, interest rate, employment levels, inflation, and consumer confidence. For example, if the economy of a country is uncertain, then consumers may not be willing to spend on non-essentials like entertainment and other discretionary items. But if the economy of a country is flourishing, then consumers will be willing to spend more and more money. Duh! Investment in context of GDP refers to the total amount of money spent by businesses and governments on capital goods such as equipment, machinery, and infrastructure. Investment is considered as one of the four main components of GDP, along with government spending, consumer spending, and net exports. Investment spending mainly includes expenditure on things such as factories, office buildings, transportation infrastructure, and research and development. These expenditures are often intended to increase production capacity, improve efficiency, and spur economic growth. Investment is an important component of GDP as it contributes to economic growth and productivity. By investing in new technologies, equipment, and infrastructure, businesses can increase their productivity and their output, which can lead to higher profits and greater economic growth. The same way, governments can invest in infrastructure such as roads, hospitals, and other government schools. Then, as they spend more on infrastructure, government spending will increase, leading to greater economic growth and will eventually stimulate the economy. Overall, investment is an important driver of economic growth and development, and countries that invest in infrastructure and technologies tend to be more prosperous in the long term. Government spending refers to the amount of money that a government allocates for infrastructure, welfare programs, defense, healthcare, etc. for the well-being of its citizens. Government spending is a key component of the GDP of a country, along with consumer spending, investment or business spending, and net exports. I also separately created a video on government spending, and you can watch the same by clicking on the link Government Money. After clicking on the link Government Money, you will open the playlist, and the latest video is on government spending only. You can also watch other related videos by clicking on the same link. Governments spend money to provide services that are essential for the functioning of a society, such as maintaining law and order, keeping the environment clean, and ensuring that everyone has the basic necessities. Also, the government may spend on different goods and services for stimulating economic growth or reducing social inequalities. Factors that influence government spending include political priorities, economic health and stability, demographic changes, level of public demand for goods and services, etc. example, if the economy of a country is in a recession, then the government can create new jobs by spending on infrastructure and boosting their spending. Also, they can spend on welfare programs so that they can increase the welfare of their citizens. Now, how will they create new jobs? By spending on infrastructure? Well, when they spend on infrastructure, let's say they want to make a bridge somewhere in middle of a river, then there will be people employed to make that bridge. So the unemployment rate will decrease. Government spending can have significant impacts on a country's economy and its citizens. When a government invests in public goods and services, then it not only increases the citizens' quality of life but also promotes economic growth. However, excessive government spending can lead to inflation, deficits, and debt, which can have negative consequences on a country's economy. Therefore, it is important for the governments to balance their spending priorities with fiscal sustainability and stability. Each country is special because each country can produce a specific product in huge quantity every year. For example, India produces so many pulses per year, but now every country doesn't have that many pulses for its growing populations. So, India exports its pulses to other countries in return for US dollars, which add up to India's foreign reserve. Exports refer to goods and services produced in your country that are bought by buyers of another country. The exports of goods and services is the main component of international trade and can significantly impact the country's economy. Exporting goods and services can help to generate revenue and create jobs in industries that produce goods and services for exports and can lead to increasing efficiency and competitiveness among these industries as they are forced to produce high quality products at a competitive price to compete in global markets. Exports can also maintain a country's trade deficit and increase its overall economic growth. Some of the key factors that can affect a country's exports include 1. Global economic conditions. 2. Trade policies. 3. The strength of the country's currency. 4. The availability of raw materials and skilled labor. In addition, countries that invest in innovation, research and development, and technologies tend to be more successful in exporting high-value goods and services. Overall, exports play an important role in the global economy and can provide significant benefits to the countries that engage in international trade. By increasing exports, countries can create jobs, stimulate economic growth, and last of all, improve their overall competitiveness in the global marketplace. Imports refer to goods and services that are produced in another country but are bought by individuals, businesses, and governments of your country. Imports are a a significant component of international trade and can have significant benefits to a country's economy. Now let's check some of the main benefits of imports. The main benefit of imports is that it offers consumers of the country a wider variety of goods and services than the ones that can be available domestically. Now, by domestically, I don't mean that the variety of goods are more than those produced by domestic animals, but I mean that the variety of goods are more than the ones produced within the country. Okay? Now, another benefit of importing goods and services from other countries is that they provide raw materials, components, and other inputs necessary for production of businesses. Also, when you import goods and services from other countries, it will increase the competition in the domestic market, leading to lower prices and higher quality goods and services. Some of the key factors that influence a country's imports include the strength of its currency, trade policies, tariffs, and trade barriers, and the availability of domestic substitutes. In addition, imports can also depend on consumer preferences, such as if consumers prefer foreign-made goods, then the imports of that country will increase as the demand will increase. And also some other factors that influence imports are global supply and demand. Overall, imports play an important role in the global economy and can have significant benefits for countries that engage in international trade. By importing goods and services, countries can have a wider variety of products, stimulate competition, and last of all, they can promote economic growth. However, excessive imports of goods and services can have negative consequences on a country's economy, because then there will be a loss of domestic jobs and industries, and there may be a vulnerability in the changes to the global economic conditions. Now, there is no exports or imports in the GDP, right? The only thing that resembles like them is net exports. So now that I've told you exports and imports, you might have understood that they have some role to play in the net exports. Actually, net exports means exports minus imports. Now let's understand it through an example. In the financial year 2021 to 22, India produced pulses exported pulses worth around $1.5 billion. But it imported pulses worth around $400 million. Now, this means that India's net exports of pulses in the year 2021 to 22 was positive, as even a first-class child would understand that 1.5 billion is greater than 400 million. Now, after seeing the equation, it looks like GDP is the best tool to measure the economic health of a country. But the hard truth is, it does have some disadvantages. It is important to note that GDP is just one tool to measure the economic performance of a country, and it does not count income inequality, environment sustainability, and the quality of life. Just think about it. A company is having a very large factory in any country, let's say for example India. So there it is producing many high quality goods and services in that particular factory. But the factory is also polluting a river nearby by releasing a huge amount of waste into the river. Due to this, many people are falling sick and animals and birds are dying by drinking that water. But in the GDP, it is showing that India has a very high GDP and a very high economic growth without telling anything about that spoiled river and the amount of waste being released by the companies into that river. Just think about it for a while. Despite these drawbacks, GDP remains as the important measure of economic activity as it always has been and is used by policymakers, economists and business leaders. By tracking the changes in GDP over time, governments can keep a track of economic policies and businesses can make the decisions about how much will be their profit if they invest capital for a new branch in the country. Now let us talk about GDP per capita. GDP per capita is the measure of the average economic output per person in a specific country. It is calculated by dividing the GDP with the country's population. It indicates the standards of living and economic well-being of the population in a given country. But the problem with GDP per capita is that it is not showing the income inequality between people. Because of course, a person who owns a company, for example Mr. Mukesh Ambani, who is the owner of the company Reliance, will earn more than the employee working in the company, in this case Reliance. GDP per capita can vary widely from country to country, depending on different factors such as economic development, resource endowment, and political stability. For example, high-income countries such as the United States and Switzerland will have a higher GDP per capita than low-income countries such as Somalia and Haiti. Also, GDP per capita can vary significantly within a country, depending on different factors such as regional disparities, inequality, demographic characteristics, etc. For example, urban areas may have a higher GDP per capita than rural areas. While GDP per capita provides important insights into the economic well-being of a country's population, it is not a comprehensive measure of the overall well-being, as it does not take into account various factors such as environmental quality, healthcare outcomes, and social welfare. Therefore, it is important to consider a range of indicators while assessing the overall well-being of a society. Now let's talk about GDP growth rate. Now, many times you must have heard the words negative GDP, positive GDP. But what do they mean? Don't worry, I'm gonna explain them right now. Well, actually, the people who are saying those terms are actually referring to the GDP growth rate. Guys, there's a marriage party or some anniversary going on nearby. So if the sound of those songs on the loudspeaker are coming sometimes, please don't blame me. These things happen all day. So, where were we? Oh yes, we were talking about GDP growth rate. Now, what is GDP growth rate? GDP growth rate is the percentage of any increase or decrease in a country's GDP or gross domestic product in a particular period of time, usually a year. A GDP growth rate shows whether the economy of a country is shrinking or growing. So, now how do we calculate GDP? Very easy. Just another formula. So, very easy. Just take out the difference of this year's GDP with last year's GDP, okay? Like this year's GDP minus last year's GDP divided by last year's GDP, and as we want the percentage of it, we will multiply it by 100, okay? Now let us understand how to calculate GDP growth rate through an example. Let's take the example of any country. Let's make a country of our own. How about Mahinia? So in the country Mahinia, let's say in 2022, Mahinia had the GDP of $20 trillion. And before that, it had got the GDP of $19 trillion. So let's calculate the GDP growth rate. So first we gotta do 20 trillion minus 90 trillion, and then we gotta divide that by 19 trillion. And then we gotta multiply it by 100, which equals 5.26%. A positive GDP growth rate shows the sign of an expanding economy, while a negative GDP growth rate shows the sign of a contracting economy. A country with a positive GDP growth rate is considered with a healthy economy, while a country with a negative GDP growth rate is a cause of concern. However, we must not judge countries by their GDP growth rates too much, because we must take other factors also into place. For example, the ones like inflation, unemployment rate, and income inequality, which means that the income is not equal amongst the society. Now, what is a recession? A recession is a period of significant economic decline, which is characterized as a decrease in GDP or gross domestic product, trade, and employment. A recession can be caused due to a number of reasons. For example, it may be a fall in consumer spending or a decrease in investment, maybe a decline in exports or a financial crisis. The National Bureau of Economic Research, in short NBER, defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Recessions have significant impact on individuals, businesses, and governments. During recessions, businesses struggle to stay afloat and many losses in jobs happen. Also, it'll lead to decreased consumer spending. Governments may also face challenges because they will have a lower tax revenue. Thank you for tuning into my channel, Mini Money Mastermind with Mahira. I hope you found the information helpful on your journey to financial success. Don't forget to hit the like button and share my videos with your friends and your family so that they also can benefit from my content. I appreciate your support and can't wait to continue bringing you more informative and actionable finance related content. Until next time, happy money management. And do you know what is the quote of the day? Well, today will be a little different from other days, because instead of one, I'm gonna tell two quotes today. Well, the first quote is, do not give up. The beginning is always the hardest. And the second quote is, do not be afraid to give up the good and go for the great. Thank you. Goodbye.